Good afternoon. It is Sunday, the 2nd of January, and this is the Stage Analysis Members Weekend video. And this is going to be part one, as I'm going to separate this into multiple videos, as there's a fair amount to go through this weekend. So, with it being the end of the year, so I wanted to do a decent feature on what's going on with the market breadth and the major indexes and groups to start with. And I'll go into the individuals stocks later in the video in part two. So starting off this week, we'll start with the major indexes. So this is the S&P 500 chart. As I talked about in the midweek video, we've got with these 3 points, touch points, we've got what Stan Weinstein referred as considered a valid trend line, so which enables us to draw a channel on this. We've broken out from the near-term base from in a phase B at the moment, so there's potential that this could still be an upthrust in phase B at the moment, as we had a near-term buying climax and automatic reaction and secondary test. So that's phase A of a base structure. Then we've moved into phase B with the testing of the base, so we've got a little bit of an overthrow here at the moment, so which could potentially continue on up in the channel, as we're only in the mid part of the channel and we're holding above the plus 1 ATR level. So you can see the 1 ATR level is at 4754. We closed at 4766 on Friday with a minor pullback at the end of the week. Obviously volumes much lower than we're used to with it being end of the year and institutional traders not around very much. So whether this continues on into New Year, we will see. But if we look at it compared to some comparisons that we've had recently, is that the large caps have been the only reason that the S&P 500 has been going up in the major markets. But if we look at it compared to the equal weight chart, you can see the equal weight chart ended the year actually at new highs, and you can see the relative strength line here was starting to pick up. Actually, it may have been underperforming since October, but it's starting to turn around since the start of December. So that doesn't hold true now in terms of the equal weighted index is actually starting to outperform a little bit. So it's not just the mega caps holding it up anymore, but obviously all stocks in the S&P 500 are starting to participate now. If we look at the comparison chart of this, so this is the S&P 500 versus the Nasdaq Composite and the Russell 2000 small caps and the IBD 50 down the bottom here, which is just out of view. You can see relative strength wise, the S&P 500 has been outperforming. We've got a breakout to new highs here, which is it managed to hold above during the final week of the year, whereas the Nasdaq didn't make a breakout to new highs, actually forming a lower base in here. Did break out of the near-term pivot there, but has rolled back under that and starting to come back into its basing structure again. So we've got a potential phase B type action in here. As I said, looks like phase B action across the board, but the S&P 500 showing the strongest relative strength versus you can see the Russell 2000 small caps is much weaker, making a base in the lower half of the structure, which it didn't actually manage to break above. And the IBD 50 CanSlim growth stocks is the weakest of all and couldn't even make a breakout from the near-term structure that's formed in the lower end of the base. And you can see the break below was much deeper than it had early in the mid part of December there. So CanSlim growth stocks tending to be the weakest at the moment, and the S&P 500 is leading there. If we go into the Nasdaq Composite, you see closed the week just above the 50-day moving average here. The 21-day EMA is also in line with the 50-day there, and the 200-day is still rising strong, and we're still a fair way above the 200-day moving average there, around 6 to 7%. We're forming up, as I said, in a phase B of a base structure here. So we can see from this, we just quickly drag in this kind of area here. So a lower base structure in here, but the major base structure above. So you're buying climax into automatic reaction, secondary test. So we're chopping around in phase B of a base structure. So we're looking for rebound that hold these near-term moving averages and a rebound up back out here through the near-term pivot to confirm the potential W bottom type pattern that's forming on here, and the relative strength to start coming back up above the zero line here, with ideally some stronger volume coming back in, but being indexes, you don't get the same type of volume as you do in individual stocks, so less important in that case. The Russell 2000, been talking about obviously the massive stage 3 base structure that's been forming all year. We had this failed stage 2 continuation breakout attempt, which then turned into a UTAD, which is an up thrust after distribution. So with the failed backing up action, it dropped back down into the base again. So literally, if this was a sign of strength rally, then you would expect the backing up action to hold up above the top of the range and start to form a higher base up in this area, but obviously dipped immediately back down through the 200-day moving average, back into the lower part of the base, and even tested the bottom of the base with a local spring in there. So again, a bit of a W pattern forming on this one. Could potentially, if we can get back through these near-term levels here, back through this kind of area, then could start to get interesting again as it starts to attempt to break back out of the base again. But at the moment, as you can see, it's rolling over at the 200-day moving average here. So if it continues to pull back into here, then a break below the bottom of the base could send it down into stage 4. So if we look on the weekly chart here, I can show you the broader, this big stage 3 base that's been forming throughout the year. We've got that up thrust after distribution there. We've got a lower high in here. So up thrust after distribution, last point of supply, and then potentially could roll over here. So if it does come back down through here and start to break to the lower side, then that would be your stage 4 breakdown. However, if it can hold up, can start to form up and tighten up in this area up here, and then start to break back through here, then we could potentially start to move back out into stage 2 again. So still in the similar situation that it's been in for a long time in terms of lots of sideways choppy action at the moment, but you can see the relative strength line still remains a long way below the zero line here. So underperforming the S&P 500 massively. If we move on to the IBD 50 stocks, as I said, weaker, same sort of price action in terms of had a sign of strength rally and a potential backup, but then the base started to come back in, formed a W type, reverse W type pattern there, come back through here and made a sell as it came back down through this area. So, and it's pulled back up again, potential some local spring type action, but it need to start to clear these near term moving averages here. Still got resistance at the 200-day, and we've still got the 50-day moving average up there as well. If I pull in the near-term chart here, you can see it's just got back above this 21-day moving average again. So if it starts to fall back below that 21-day moving average in there, then it could potentially move back to a short again. But if it can hold up on this, as you can see from the weekly chart here, got this massive stage 3 base that it's been in. If it can start to form up back above the 30-week moving average and 10-week moving average here, we can get back into this kind of area and start to form up in there and tighten up, then potentially could be on for a stage 2 continuation. But as with the Russell 2000, if it can't get back through these near-term levels, we start to see it moving back to the downside again, back to this way, and then starts to break to the downside through some near-term levels, then potentially could move off into stage 4. So still anyone's game on the IBD 50 as well. ARK-K, so this one obviously a lot of people were using last year as a proxy for the market strength was really strong with the growth stocks, but this year, as you can see, it's been going sideways to nowhere and started to drop off into stage 4. You can see the base that we broke down into stage 4, and then we've had a spring attempt here after around the lows, but you can see it's come back up into a resistance zone, and it hasn't actually broken down. It hasn't actually managed to spring back out. So if it was a spring type action, you'd expect to see really strong behavior coming back through the near-term moving averages, back up into the base structure, and then following through quickly. But obviously it's struggled for 4 weeks at the moment here. So at the moment, continuing to look weak. So again, if it pulls off down, breaks another low there, we potentially make a stage 4 continuation, but remains in stage 4 at the moment. And as you can see, relative strength line remains below a declining zero line here. So this is your relative strength compared to the S&P 500, the black line, and then there's the 52-week moving average is the what we call the Mansfield RS0 line. So in order to be outperforming the S&P 500, you want to see this black line above this blue line here, as we can see throughout the majority of last year's rally. So at the moment, ARK-K remains in stage 4, and potential for a stage 4 continuation breakdown if this little minor base structure in here doesn't form up. At the moment, though, there are some signs of it attempting to base in here. You can see these 2 big volume days in here. So if I zoom in on the 2-hour time frame, you can see this on the 2-hour time frame, the stage 4 declining there has turned into a stage 1 base. So quickly mark up this area here. So you've got your selling climax into your automatic rally. So selling climax into the automatic rally, secondary test area. You see these volume bars in here. So these big volume bars. So these two bars in here are now key in terms of actual support. So if the price can hold in this kind of area in here and not break below the lows of this area, and then start to rebound and come back up through near-term pivots, then this one could potentially move off. You've got multiple near-term pivots in there, so if it can get a move out of here, strong relative volume, another big volume bar like we've seen with these here. So attempting to form a stage 1 base on the intraday here. So if it can do that, then potentially got an intraday stage 2 breakout, and then that would complete the spring type action. But again, if this actually continues to roll over and we start to break to the downside in this, then stage 4 continuation to the downside. But at the moment, the intraday is certainly trying to base, but could be a bear flag at the moment. But stage 1 behavior at the moment, you can see there's some stopping action and not much in the way of supply, but it was a light week in terms of the volume, so hard to tell on that one at the moment in terms of whether the volume is to be trusted or not. Right, that'll do for the major indexes. Let me just pause a sec. Okay, next up, let's talk about this is what we call the Dow Jones US Industry Groups Relative Strength Table. So this goes from a score of 0 to 100. So this is done via using Stockchart's SCTR ranking system, which is very similar to other trading services RS rankings, but it uses its own calculations using short, medium, and long-term measures. So you can look that up in Stockcharts if you wanna see how it's broken down. But this is the 104 Dow Jones US industry groups, which covers like the vast majority of stocks in the market. So at the moment, the top score ranking is 100. So aluminum is our top ranking at the moment, followed by automobiles and then food retailers, and then home improvement retailers, computer hardware, trucking, coal, tires. They are our top at the moment. In terms of the bottom at the moment, you've got renewables has been bottom for 2 weeks now. See the 0 on the 1 week table there. That was 1 week ago, so it hasn't moved in terms of it moved back to the bottom. So it was a group that was moving strongly. It came off the bottom of the table early in the year. So you can see at the moment there's not much that's doing well, but a few months ago or a month or so ago there was some strong moves. First Solar even made it out into stage 2 for a little while. So we had a little stage 2 breakout, but you can see how much the likes of that has come back in now. It's fallen back below its 200-day moving average here. And you can see, let's go. What else we got? Sedge. Let's open a couple more and run. So same thing, intraday. We had some bases forming, some base structures. So SEDG, Solar Edge was another one that was forming up and did well during that October rally. You can see broke out of the base structure into potential new stage 2, couldn't make it above the top of the range low. So the broader structure, double top type pattern has fallen back in to the base structure again. You can see the relative strength has started to pull down on that one. Again, same thing with SunPower looking much it's come off back through this 200-day moving average. We had a little pop up, attempted to move out into stage 2, but failed immediately and fell back into the base again. Now testing the bottom of the base on the weekly chart there. And again with Sunrun, another one looked like it was potentially going to make a stage 2 breakout here. So we go on the weekly chart up, so you can see the base structure that was forming in here. We've got a lower base and this broader base, so potentially from this we've got a couple of structures in there. You can see it was attempting to get near potential breakout area, so at this point here it needed to tighten up and then make a stage 2 breakout attempt, but instead rolled over, as you see with a lot of these type of ones, and obviously with the group weakness, and has now broken down into stage 4 again. And as I said, First Sailor, same sort of thing, breaking down. Right, let's go back. So other weak groups, toys has been one of the weakest groups for many months now. You can see for 3 months it's been near the bottom of the table. I think it was actually the bottom group for a while. Gamblin's been weak. Brewers was one of the weakest for a long time and still hasn't really moved off the bottom. So those are generally areas to avoid until they start moving back up the rankings table. So what we want to see is, for example, renewable energy to start, or any of these lower ones to start turning around. And once they start getting back up through the 30 level or 50 level, they can start to get much more interesting, as they'll be starting to develop in potential stage 1 at that point. In terms of our strongest areas of the market, semiconductors has come off a bit in the last week, dropped down 8 there to 13th. So it was in the top 10, was near the top of the tables a few weeks back. See, it's moved down 10 points in the last 4 weeks. But if we look at the 1 week chart, so we'll zoom in on this. So this week, strength was in consumer staples, real estate, materials, staples again, materials, so drug retailers, REITs, food products and mining, utilities, gold mining. That was the areas of strength from the 1 week. But if we zoom out to the 2 week, see it's a little bit different. Hotels and hotel and lodging actually was stronger the previous week before that. And if we go out to 4 weeks, what have we got? Real estate again, materials, staples. So it's been a lot of defense over the last month here. But if we go back into our top groups at the moment, there was a few standouts that I noticed this week in terms of home improvement retailers had a strong week, moving up 7. There was a few in this group of interest, HD and Low, which, as you can see on the 2-hour chart here, just ran from the 20th straight up. Let's see, off the 50-day moving average here and back up above the 180R level. So just tapping on the 280R level and back near the top of the range. So currently forming, you've got a buying climax and automatic reaction in secondary test. So phase A of a potential base structure here. But on the weekly chart, as you can see, we're in a long-term stage 2 and near the top of a sort of flagging type formation, a little bit sloppy. So it could be forming a new trading range here, but if it can make a continuation breakout, then we're still hanging around in stage 2 there. Same with Low, similar sort of price action, buying climax, automatic reaction into a secondary test at the moment, but getting back above that 180R level. As I said before, when you're above this 180R level, you're generally in a strong up trend. When you're below the 180R level, you're generally in a downtrend. So getting back into bullish position again. You can see from the weekly chart here again, got this strong stage 2 advance that it's been in. It's had multiple base structures now, like big bases. So two major base structures. So potentially forming starting another base here, but could be some tennis ball action as it held at the 10-week moving average there and rebounding. So could easily break out to new highs and make a further stage 2 continuation attempt. Was there one more? Oh yeah, and automobiles. I wanted to hung around second position this week again. Tesla's been strong over the last few weeks, but there's been a few in this group starting to pick up. We got earnings or sales figures from some of the Chinese on Friday or Saturday. I think XP EV had the strongest of the numbers, followed by LI, and then followed by NIO in terms of the Chinese manufacturers. So if we have a quick look at those, you can see the type of areas they're in at the moment. So we've got this base structure that's been forming. You can see that on the weekly chart here. We've got this stage 1 base, attempted to make a stage 2 breakout and failed there, but potentially starting to move back into it again. So you've got this stage 1 base structure in here, failed stage 2 breakout attempt here, pull back in, so potential attempt to move back into stage 2 again. If we go back down onto the daily time frame on this one, you can see the base structure in more detail there, so this is your, from the top here, so this is your stage 1 base. So this area is your stage 1 base coming off the bottom. So you've got your selling climax into an automatic rally. So potentially would mark the base from here actually. Let's get rid of the other one. That's just a secondary up thrust level, which I'm sticking as a dotted line. So basically this is your stage 1 base area. We've got this failed stage 2 breakout attempt, which followed through on earnings on strong volume. You can see this significant reversal bars here. So strong volume reversals, come back into the range, but rebounded at the 200-day moving average here. Higher low, rebounding back out of the base again. So this one, we've got potential for a new stage 2 attempt again. Go onto our elder impulse here, you can see the momentum's turned positive. We're getting back above this 180R level again here. So XPEV is looking interesting there. Neo, is it Lee or Neo? Did I show you Lee? I showed you Lee as well. Lee, similar sort of behavior, but not as strong as XPEV. I keep saying it wrong. But similar sort of action here. You can see the stage 1 base that's forming up on this one in here. So currently in stage 1, to move into stage 2, we're looking for a strong move out the top of the range here. You can see there's resistance levels as well, this kind of area. And you've got obviously upper resistance zone up here. So you'd be looking for a strong move on strong relative volume out of the range here. So stage 1 potentially for a stage 2 breakout attempt. And then Neo has come off a lot. It's been the weakest of these Chinese manufacturers for a while now. It was really strong last year. It was one of the leaders last year. I think it had like an 800% move last year. But you can see this base structure that's been forming. It's looking a little bit like ARC. It's spring type action at the moment. So we need to see, for the spring to complete here, you need to see a real strong move up through the 30-week moving average there, strong relative volume, and then for it to continue on up through near-term resistance areas here. So in order to get back to stage 2 type behavior. But if it can't do that, it starts to roll back over again, then that could potentially drop off into stage 4 there. So one to keep an eye on. It's the weakest of those 3, but XPEV looking the strongest there. Let me close up some of these. Okay, right, moving on. Let's move on to the market breadth next. So for me, this is what I use for my market timing and general sort of strategy. So I've talked about this obviously each time I do the videos. So for anybody new, just obviously look back through some of the older videos if you want much more detailed instructions on how this works. This is the US total percentage of stocks above their 50-day, 150-day and 200-day moving average. And in simple terms, when this red 50-day moving average line here of the combined averages is when you're above that 50-day moving average there, you're in a positive environment, and when you're below the 50-day moving average, you're in a negative, or in a difficult environment. I don't like to say negative. You're in a difficult environment, as you can obviously still be making gains on the long side during that period, but as we've seen throughout the year. So as we know, if we go back to like the Russell, where are we, the Russell, you can see obviously the general market has gone completely sideways, and we've percentage of stocks has been drifting and got all the way down to the 30% level down here recently multiple times. So we've got into the lower zone. As I've said previously, the only times we've previously been into the lower zone for the combined averages was during late 2018 when we were in stage 4, and during the February-March 2020 period here when we were in stage 4 again. So at the moment, the market is not in stage 4. As we know, we are in stage 2 in the actual broad market. So if we look on the weekly chart here, we're still in stage 2. Russell is in stage 3, and IBD 50 is in stage 3. So generally, large caps outperforming, but this is highlighting that we're actually very close to stage 4 territory on individual stocks versus what's going on in the large caps per se. So we're getting quite close now to the declining 50-day moving average here. Like we're only 2% away from that for it to turn back to a positive environment. And like we saw back in the October to November period, when we moved into a positive environment, you got some very strong moves in individual stocks, especially some of those oversold growth stocks. And same back in sort of middle May to early June time, we had this little pop up here. I highlighted on the private Twitter feed on Saturday that there was only 4 periods this year where you could have been obviously made strong gains when this was in a positive environment. So when we were up in this area here, obviously this peak here, this small peak here, and then this area here. So there's only been 4 brief periods throughout the year where it moved into a positive environment. There was actually 5, sorry. There was the whole of January bit here, and then into February, and then so 1, 2, 3, 4, 5 times when you could have actually, when we were on a strong positive environment for more than a day or two. There's been obviously some brief pops for a day or so through it, but generally where it's held for a month or so up in a positive environment, and then everything that's deeply oversold has rallied strongly, and the strong RS stocks have moved off to new highs, so which we saw recently. So ideally, hoping for this to get back above this 50-day moving average for the market to move back into a strong environment. But at the moment, with it above the 20-day moving average, but still below the 50-day moving average here, this puts this in neutral territory at the moment. So we're still below the 50-day moving average, so we're still in a difficult environment. But strategy-wise, we're on neutral territory with progressive exposure, basically. So until we get back in when we're in a positive environment, that's when you want to start getting back towards fully invested using this kind of technique. So that's that. If we look at it on the individual, actually look at the point of figure chart here first, you can see we made a double top breakout this week. We're at 42% there. So this has actually moved on point and figure signals using the bullish percent index statuses. We've actually moved back to bull confirmed signal with that double top breakout this week. So on the point and figure chart. So, but on this chart, we're not above the 50-day moving average. So again, I'm in a neutral sort of plus territory here at the moment, but with progressive exposure, bull confirmed on the point and figure. Individual charts. So this is the NASDAQ. This is the NYSE 50-day. So bull confirmed on that one. If we look at it on the 150-day, bull confirmed signal. The NYSE 200-day double top breakout. So bull confirmed on that. So the NYSE is moved to bull confirmed status. NASDAQ short-term 50-day moving averages, bull confirmed. If we go to the 150-day, we have not broken out yet, so we're in bear correction on the 150-day, so medium term. Then the NASDAQ 200-day moving averages, percent above those, is still on a column of O's, and back above the 30% level here. So if that moves back to, it's currently still on bear confirmed, but if it reverses back to a column of X's there, so it makes another few percent move, then that would move to bull alerts, because when you move out of the lower zone back through the 30% level, you generate a bull alert signal. So if that can reverse to a column of X's, then that would move to bull as well. But at the moment, NYSE is on bullish, and the NASDAQ is short-term bullish, but long and medium terms still not there yet. If we look at it on the individual split up chart, so this is the NYSE percentage of stocks above 200-day, 150 and 50-day at the bottom here. So you can see it's split up on the line chart for those that can't read point and figure. As you can see, starting to move back into favour. NASDAQ, not so much, coming out of the lower range. We had a flat week overall, so you can see the difference between the NYSE and the NASDAQ in terms of the relative strength in the NYSE currently. Look at the individual charts on the NASDAQ, so you can see it got all the way down into the lower zone, so matched what we saw 2018 and March 2020 when we were in stage 4 territory. So the NASDAQ actually got into stage 4 territory in terms of this breadth indicator while the market was still in stage 2, whereas the NYSE has not made it down into the lower zone. You can see this got all the way into the lower zone in 2018 and in 2020. So in order for the broad market to move into stage 4, the NYSE has to cooperate with that, as this has a lot of the financials and industrials and utilities, etc. So if they're still holding up, then the market still holds up. So as you can see, we're getting right back up towards the 50-day moving average on that one, and the Nasdaq is a little bit off its 50-day moving average still. Right, moving on, the NYSE bullish percent index. So this is often referred to as the head coach in terms of the markets at the moment. If we look at this, look at it quickly on the point and figure chart, you can see on the point and figure chart it's moved back to bull confirmed status here. So we're on a column of X's and we're on bull confirmed. So that means get on to offense. And you can see the Nasdaq, it's been declining through the years since topping early in the year. We've come all the way back down into the mid 30s and starting to rebound. Again, if we look at the point and figure chart on this one for the status signal on this, it's reversed to a column of X's, so it's on bear correction status at the moment. So again, Nasdaq generally weaker than the NYSE. If we look at the NYSE advanced decline line, so back through the 50-day moving average this week and just tipping out of the base structure, so it's starting to look a little bit more positive. So I'd put that at neutral at the moment. If we look at the EMA crossovers of this, so this is the 10 and 30-day EMA crossover of this chart. So this gives signals. So when it crosses over and crosses down, it gives signals. So we've got a crossover to the upside there. So a bullish signal for that one. Nasdaq, as we've since early in the year, has been declining below this 50-day moving average, still near the lows of the chart, so still on a bearish at the moment. You can see from the crossovers, it's nowhere near crossing over its EMAs, so crossed to the negative side in the middle of November there, so the Nasdaq is still on a bearish signal there. And then the McClellan oscillator getting back up near the top of the range, so a little bit short-term overbought here. Higher low after getting short-term oversold back in early December there. So and then a higher low. So we want to see this hold in the upper range. When you're in bullish mode, this just tends to hold up in the upper range above the zero line. You can see the summation index cross back to the positive again. It's not above the zero line yet, but it's crossed above its short-term moving average. So NYSE again is on a bull signal there. Nasdaq, same sort of action. Not strong in terms of the McClellan oscillator, hasn't got up near to the top of the range yet, but holding above the zero line, and the summation index has just turned up positive as well. So bullish signal on that one. New high, new lows. So this is the NYSE again. So not much in the way of new lows in the NYSE. New highs 131 on Friday to close versus 42 new lows. So still looking reasonable in the NYSE, whereas the Nasdaq has been popping out a lot of new lows since November, and 174 new lows versus 84 new highs on Friday there. So new lows still dominating in the Nasdaq at the moment. And as we can see from the cumulative line, signal on this one is when we go through this 50-day moving average, so the red line. So it crossed over in May last year. So it's a little bit of a slower moving sort of signal on this one. So that was your bullish signal on that. So it's crossed in November, end of November here. When was that? So we look. Yeah, start of December, crossed to the negative. So at the moment, this is on a bearish signal still. If we look at the 5-day average of this, you can see it's still bearish at the moment. It hasn't got back through the zero line, sort of neutral negative at the moment after making a higher low there. Right, some custom breadth charts quickly before we finish up. So this is the cumulative point and figure breakouts minus breakdowns that I do each day. So it's the amount of stocks on a point and figure buy signal versus point and figure sell signal. So it gives you an equal weighted kind of look at what's going on in the market, similar to what we see in the advanced decline line. And these lines here, the red line is a 20-day moving average and the green line is a 50-day moving average. We've just moved back above the 20-day moving average, which I use as a short-term signal line. So we've moved back from a difficult environment into neutral environment at the moment. If we can get back above the 50-day moving average again there, then you would potentially move back into a positive. The greater than 180R, so this measures, we go all the way back to the start here, so the 180R line is this, so the 21-day EMA, and then the 180R line is this first band here. So when stocks are above this 180R line, they're generally in an uptrend. So we go back. This chart measures the percentage of stocks in the S&P 1500 above their 180R line. So you can see at the moment it's at 35.93% there, versus the stocks below their minus 180R line at the moment, which is only at 3.2% there. So vastly different at the moment. Out the percentage of stocks above their 35 to versus 3. So if we look at the cumulative line, it's crossed back above its 20-day moving average there. So we're back on a bullish signal for this one too. And then finally, to finish off, I'm going to look at the effective volume, which is from effectivevolume.com. So really useful site for looking. It splits up the large player volume and the small player volume. If you want to know how it's all calculated, then you need to read the book Value in Time by the author of this site, which was published maybe 2008 sort of time. So quite a complicated book, but it tells you how it's all kind of works and the systems he uses. But I use it in a very simple way. There's a free area on the site. If you go into ETF review, and then it splits up the QQQ, the S&P 500 and the Russell 2000 and their various leveraged ETFs of those. So if we look on here, the green line is the large players and the red line is the small players. So when the green line is obviously accumulating, it's generally positive, especially when it's doing the opposite to what the small players are doing. And then we have the cumulative line of both. So you can use stage analysis on the cumulative line. So at the moment, we broke out from our stage 1 into potential stage 2 at the moment here on the QQQ. If we go down to the Russell 2000, you can see the Russell 2000 large player interest has been fairly flat throughout December. Small player interest has been picking up. So a little bit of a negative divergence there. But you can see on the cumulative one here, we've moved into stage 1. If we go down to the S&P 500, so the S&P 500 since early December has been accumulating. You can see how the small players were fairly neutral throughout early December while the large players were accumulating, and see only at the end of December when small players started buying and the large players started selling a little. But at the moment, if we look down at the cumulative of the two, you can see we moved out of stage 1 and into stage 2. So that's the lot for your market breadth. So basically, from general weight of evidence and what's going on in the market indexes, we've started to have some short-term positive signals. We're on a sort of neutral strategy-wise. We're on, as I said, neutral sort of plus at the moment, but we're still in a difficult environment. But there have been some short-term bullish signals. So potentially, if they can follow through, then the weight of evidence could turn back to the upside overall. But at the moment, we're kind of intermediate in the middle of both, really. So, but leaning slightly on the bearish side still. So don't be at the moment still defensive kind of strategy wise, but more neutral with positive with progressive exposure, just to test the waters and start to see. And if trades start to work, then that's when I'll start to get more aggressive again. Okay, so that's a lot for this. Anybody watching that wants to see more of this? So I do this each week for the Stage Analysis members. On the Stage Analysis members service via private Twitter and the Stage Analysis forum. So I do a midweek video and a weekend video, and I also I'm going to do a part 2 a little bit later on, covering individual stocks from the watch list and stocks in focus this week. And I might attempt to have a look at some of the more interesting stocks of the year if I've got enough time. But yeah, so if you're interested in that, then come over to the stageanalysis.net and join up. Okay, thanks for watching.